Do you want to know how to invest like the pros? Maybe you just want to be able to afford a house one day or retire early. Everyone has to get started somewhere. So in this Investing 101 course, we're going to take you through everything that you need to know about investing. We'll start with some basics about different markets and how they work. Then we'll talk about the different types of assets that you can invest in. After these basic concepts are out of the way, we'll talk about some of the worst case scenarios when investing, like the biggest crashes, and even consider what the future of investing looks like. Finally, we'll close out the course by reflecting on whether you should invest and whether you're ready. So, with the introduction to this course out of the way, let's start with Section 1. Understanding the markets. To understand investing, first we're going to need to understand how various markets work. Let's start at the top and understand how the stock market works. Investing in the stock market can seem like a crazy prospect for a generation of young adults that have 2 cents in their pocket and a $100,000 student loan for a degree that they don't use. But when it's done right, you can take that 2 cents, turn it into 3 cents, and well, that's more than you had yesterday. And isn't that the goal? In all seriousness, the stock market is often perceived as a big scary abyss of money that eats unsuspecting investors alive and is the path to a magnitude of wealth for those that understand it. While those perceptions can be true, understanding the stock market and succeeding in making money with it is far easier than you might expect. In order to understand the stock market, first, we need to understand just what a stock is. A stock, otherwise known as a share, is a financial token or instrument that signifies ownership of a company in some proportion. Basically, if Amazon had 1,000 shares and you bought 1 share, you would own 1/1000th of Amazon. In reality, Amazon and companies alike have millions of shares, but that sums up the point. When you own a stock, that means that you own a portion of that company, and as the value of that company increases, so does your stock price. There are also common and preferred stocks, which refer to the voting rights of a shareholder. Common shares have voting rights, and preferred shares don't. When you have voting rights, you can vote on things like board elections, mergers, and other financial decisions. Preferred shares, however, are called that because they get preference when a company pays a dividend, which is basically a split of the profit of a company with the shareholder, and they also get preference in other financial situations. Stocks can get much more complicated than that, but these simple understandings will serve enough to the basic investor. The next thing you might be wondering is why exactly companies will sell stocks. And that answer is simple: to get money. Stocks allow a company to raise massive amounts of operating capital with essentially no extra effort or product. The modern stock market often bases the value of a company off its potential earnings down the line. This means that relatively small companies can earn millions, or even billions, if investors think that they can succeed in the future. So then, if a company wants to sell their shares, they need a place to do it. Enter the stock market. Companies list shares by selling them through an initial public offering, or IPO, on an exchange. This essentially changes the status of a company from a privately held business to a publicly traded one. IPOs can let company founders cash out their stake or just let the company raise money. Once a company's stocks are listed on an exchange, the public can trade them. Usually prices will fluctuate based off of public opinion, but the more concrete trends and fluctuations are usually dependent upon a company's earnings and operations. These can be measured by PE ratios, or price to earnings ratios, as well as a variety of other metrics. This is usually where casual investors get scared and their eyes start to glaze over. But fear not, it's not as complicated as it sounds. Next, we need to understand how and why a share price fluctuates. The stock market is composed of millions of investors and individual traders who all feel different ways about a company. They all make independent choices, and the net of those choices result in the positive or negative movement of a stock. If more people buy, then the price has to climb. If everyone wants out of a company, then the price falls due to lack in purchasing demand. An example might be this. Say you post something on Craigslist for $100.
After posting, you get 100 emails saying they'll come to purchase your item all cash right now. Most people at this point might start thinking that they priced their item too low and thus raise the price until, in theory, it reaches the most that the one single last buyer will pay for it. Conversely, if you receive no offers, you'll likely keep dropping the price until someone bites. This is similar to how the stock market moves, except that the price rise and drop isn't done consciously, rather by millions of transactions every second, supply and demand, which brings us to that topic. For every stock purchase or sale, there has to be a buyer and a seller. If there are more buyers, then the price will go up. If there are more sellers, the price will go down. Traders often might talk about the bid-ask spread, which basically means the difference between the bid, or what someone is willing to pay to buy a share, and the ask, or what someone is willing to sell a share for. Supply and demand is fairly simple to understand at the end of the day. If more people want something, that thing, in this case a stock, will be more expensive. At the start of stock markets, matching buyers to sellers was done manually on a trading floor. Now it's mostly done automatically by trading systems. This allows the market to move much faster and creates the breakneck pace that any casual onlooker notices when watching the stock market. Now, you might be wondering, well, I don't have time to understand this, and why should I even invest anyway when I can earn 2 to 3% just keeping it in a bank on a high side? Well, the answer is pretty simple. If you do it right, you can make a lot of money. Using a common example that you might have heard, if you bought $1,000 of Amazon stock back in 1997, you'd have roughly $1.5 million today. Now, that's a long investment timeline, but I think most people would agree that the purchase would be worth it. Other companies often provide return rates like 30 to 70% each year, which is still going to build you a lot of wealth compared to that 2 to 3% each year kept in a bank account. In essence, as long as you're able to make more than 3% in the stock market, you're doing better with your money than just keeping it in the bank. Now that we understand the stock market to be a real-time marketplace where you can purchase a part of companies you think will succeed, the next step is to figure out how. The first thing you'll need is a trading account. You can start one with common providers like E-Trade or other major banking institutions, but you can also use free trading services like Robinhood. Common trading services will charge fees for every trade you make, but new tech companies like Robinhood have made everything completely free. That means you can invest all of your money in a company and not worry about paying fees to the brokerage. We have a link below to start a Robinhood account where you can get a free stock to download that if you'd like. Once you have an account in any trading service, you have to decide what companies or multiple companies' stock to purchase, which is arguably the hard part. You also have to have a certain amount of money. Stocks range from a few cents to many thousands of dollars. The key thing about stocks is that you can't purchase part of one. It's either all or nothing. If you want to invest in Amazon, you'll need at least $1,800, at least at the time of recording, to get started. But you can buy much cheaper, well-rated companies for a few bucks. Before you make a purchase, you want to do extensive research to make sure you understand what a company does to make money, whether they're in good financial standings, and also see what experts think about a company and whether you should buy it. At the end of the day, you do have to assume some risk, so it's important you only invest money you're capable of surviving without, at least for a little while, or until a certain stock comes back up if it does fall on harsh times.
Hopefully, at this point, you understand a little bit more about the basics of stock investing, so let's take a moment to learn a little bit more about different market terminology and scenarios. We'll start with liquidity. Do you own a lot of water? Then you have some very liquid investments. Alright, since that joke landed so well, let's actually talk about what liquidity in investing is. Liquidity, in simple terms, is how easy it is for things to be bought and sold. For example, if you own a lot of a particular asset, let's say cheeseburgers, and everyone in your town wanted to buy cheeseburgers right now, then you could sell those cheeseburgers rather quickly. This ease of being able to sell all of your cheeseburgers makes this asset very liquid. However, if you owned all of these cheeseburgers and it turned out that everyone in your town was vegan, then your asset would be considered illiquid, because it would be hard to sell your cheesy death patties to a group of people who only ate plants. Liquidity isn't just a concept to understand the definition of, it's also necessary to keep liquidity in mind when making investing decisions. To make things simpler, let's lay out all types of assets based on their liquidity. Cash is the most liquid, followed by cash equivalents almost immediately, which means other forms of assets that can essentially be instantly converted into cash. And generally speaking, stocks, treasury bills, and certificates of deposits and other forms of short-term investments are considered cash equivalents. While some cash equivalents can be converted instantly, the longest-term investment still considered to be a cash equivalent works on about a 90-day conversion to cash window. Following cash equivalents are physical assets, starting first with collectibles like coins, stamps, and art. While these assets hold value, they're going to be relatively hard to sell because they need unique and interested buyers to get their fair market value. Following collectibles is land, real estate, or property. These are some of the least liquid assets out there because they can take months to years to sell. There's usually a lot of red tape around selling these assets too, slowing down the process, making them even less liquid. With some examples now thrown onto the liquidity scale, the last thing to consider is the concept of stock market liquidity or investing liquidity. This ultimately refers to a market's ability to allow the exchange of assets quickly. A highly liquid market means that the buying pressure and the selling pressure for the market stays roughly equally matched. The result of low liquidity in stock means that there's a difference between the price someone is looking to sell it for and the price buyers are looking to pay will be greater, meaning the stocks are not very liquid. So in simple terms, that's liquidity. It's something you want to keep in mind as you're divvying up your portfolio, and you need to consider how much cash you might potentially need in the future and if you're investing for the short term or the long term. Now, let's understand what a stock split is. When you own stock in a company, you own a portion of the company itself. When that company makes more money and the stock price goes up, you can make money from buying and selling the stock. But what happens when the company decides to do a stock split? And why would a company even want to split their stock in the first place? Stock splits are when a company divides the share of its stock into a multiple of generally 2 or 3, but it can go as high as 100 or even 1,000. So if a company had 1,000 shares on the market, a stock split would turn those shares into 2,000 or 3,000 shares, generally. And if you owned 1 share at the time of a 2-for-1 stock split, you'd all of a sudden own 2 shares of the company. But the price would also be cut in half. Splitting a stock doesn't add any value inherently. It's not a way for companies to just double their market cap. So why would companies do this? Just for fun? Well, splitting a stock and thus putting more shares on the market at a lower price per share is desirable if a company wants to increase liquidity and make the price to buy 1 share more attractive to investors. By splitting up all of the shares in a company into more shares, investors have the option to sell smaller portions of the company if they want to. For example, if you owned a share in a company worth $1,000, you'd have to sell $1,000 worth of their company to sell their stock. However, if the company split their stock in a 2-for-1 conversion, you could sell just $500 of the company if you wanted to. Splitting a stock also lowers the price per share, which could make it more approachable for more investors. Small investors might see a $200 share and think that's too expensive. But if that share was split into 3 shares worth $67, smaller investors might be more willing to invest, even though the company value and underlying profits remain the same. Stock splits don't change the market cap of a company, or how much all of its shares are worth. Remember, when a stock split occurs, it just multiplies the number of shares in the market while dividing the price, or making the price proportionately less. There is one other reason why companies undergo stock splits, though. While we mentioned that it doesn't inherently change the price, when companies do undergo stock splits, generally investors get a renewed interest in the stock, and prices can go up because more people want to buy in. Some companies will even set a price barrier, where if the stock hits that price, they will split again. For example, a company could split at $100 per share, making 2 shares worth $50. If, over time, those $50 shares went back up to $100 per share, the company could split again, making the new shares worth $50 again. Over this period, 1 share would ultimately turn into 4 shares through all of these stock splits. There's also reverse stock splits, where companies want to consolidate their shares. Reverse stock splits function the same as stock splits, just in reverse, and can be used by companies to make their stock look more valuable. So, stock splits and reverse stock splits are ways for companies to make their company look better or different by altering their price per share in the hopes of making it easier for investors to buy and sell their company, ultimately causing the price to go up and the company to make more profit. You've likely heard this term before, inflation, but have you heard about deflation? Let's take a look at both to understand them further. If you've been paying attention to the news recently, you might have heard a little word called inflation. Inflation is essentially the devaluing of a currency. While many people have a connotation that inflation is very bad, inflation on its own is actually a necessary part of a functioning economy. Inflation is the reason things seem to get more expensive over time, both because goods get more expensive and a dollar goes less far to purchase things. Generally, inflation is expected as a percentage decline in value, and generally the Federal Reserve in the US targets inflation to be at roughly 2% per year. But a variety of factors cause inflation to swing up and down. Defined simply, inflation is the rate at which a value of a currency falls and the price of goods rises. People that own goods or assets generally like inflation because these goods go up in value with inflation, but people holding cash don't like inflation because it decreases the cash's value. Inflation is caused primarily by an increase in the supply of money. If a good has one value with one total supply of money, in order for the ratio of value to total supply of money to stay the same, or how generally expensive or cheap something is, when the overall supply of money goes up, so too does the value of that good. Some inflation is caused by a demand pull effect, or an increase in demand for goods, usually from more money, without an increase in supply of those goods. When there's more demand, but the same or decreasing supply, the price has to go up. There's also built-in inflation, which occurs when a population expects inflation, which they then demand more pay for the same work, resulting in people having more money, resulting in the price of goods going up, resulting in more inflation. This final type of inflation can spiral out of control without a centralized approach on how to handle it. Inflation is often viewed as good because it promotes investment. When you expect your money to be less valuable in the future, you get out and spend it now on investments that will grow to counteract the value decrease. However, inflation does generally hurt people without assets and low amounts of cash to invest. If these groups of people don't see wage increases, then over time, the same salary numerically actually becomes worth less and less. This is why countries raise minimum wages and why companies will often process annual raises. The last thing to realize about inflation is that it can generally be controlled by adjusting financial levers at the central banks of a country. By adjusting interest rates, the central bank can temper or accelerate interest in investment, by association influencing inflation. Inflation can get out of control, though, when consumer sentiment and outside factors fly off the handle. In these situations, we see hyperinflation, where a currency is rapidly devalued and economies can collapse if this occurs. But, for the most part, inflation is a carefully controlled metric and to be expected in modern economies. If inflation means the end of the world, wouldn't deflation be good? Well, actually no. In fact, deflation can be even worse for an economy than inflation. Here's how it works. Deflation, explained simply, is just the fall in overall level of prices of goods and conversely the increasing purchasing power of money. In essence, money becomes more valuable during deflation. It's generally driven by increased productivity of workers or more goods and supplies than an economy needs. So why would the increasing of value of money be a bad thing? Doesn't that mean people technically become richer by saving? Well, on paper, for individuals, sort of. But in terms of the entire economy, it can grind everything to a halt. Inflation and deflation are generally gauged on something known as the Consumer Pricing Index, or CPI. This report gauges prices on consumer goods over time and gives a good measure of how far a dollar is going in the economy. Deflation can be good if it happens slowly and over time. As prices drop, it can encourage consumers to go out and spend more with the money that they do have, consuming more goods and creating a more stable economy. However, if it happens rapidly, it can be very, very bad. Rapid deflation generally occurs when an economy is filled with debt and debt spending. If the supply of debt, and by proxy money, dries up, then there can be a rapid crunch for every player in the economy with little access to more cash. If deflation occurs suddenly, the prices of goods will drop rapidly, and people will want to hold on to their money and save it as it goes up in value just by doing that. Despite what Dave Ramsey might say, if everyone in the economy were to decide to never spend and be frugal, the economy in its modern form would nearly collapse. That's actually why the Federal Reserve, the US central bank, targets inflation at about 2% each year. This rate encourages economic players to go out and spend now before things get more expensive, but isn't so high that it damages the affordability of goods. Conversely, some slow deflation can be good, like we mentioned, especially after periods of inflation, but a sharp increase can bring the economy to a halt, bankrupting companies as prices fall, resulting in mass layoffs and more. And that's essentially how deflation works. Finally, let's understand a type of market that you'll want to watch out for, one that can result in a lot of loss, but also be a great opportunity for future investing: bear markets. A bear market is one where different types of bears trade stocks. Stocks that do their best in bear markets, understandably, are those like BBW, or Build-A-Bear Workshop, or PG, Procter & Gamble, because the bears love the Charmin bear, owned by Procter & Gamble. What? Sorry, that was the wrong script. 1 second. A bear market is when a market undergoes significant and prolonged price declines, typically over 20% in a given period. Bear markets are also characterized by overly negative market sentiment and pessimism. In general, bear markets occur in stock markets about every 3 to 4 years and generally last about 289 days. That's to say, bear markets aren't uncommon. Rather, they're a facet of regular market cycles, generally. There are also occasions where bear markets are triggered by significant external factors that cause markets to plunge. Let's take a closer look at how bear markets work, what factors affect them, and take a look at some of the largest stock crashes in history. Stocks are generally traded at prices that reflect future expectations of earnings and profits. This means that in some senses, stock prices are propped up by optimism for the future. When optimism about the growth of a company or even an entire industry shifts, then stocks begin trading on fear. This shift from optimism to pessimism usually marks the beginning of a bear market. A bear market is a fairly vague term, but economists usually try to quantify it by putting 20% as the decline needed to trigger an official bear market, or being called an official bear market. Many a bear market has been triggered by slowing economies, bursting bubbles, geopolitical challenges, wars, and more, all factors that affect how people feel about money and the future of doing business. While the average bear market lasts under a year, there's really no set time that can define it. Some bear markets can last decades. In these markets, there will still be rises in stock over a shorter given time period, but the overall trend of the market will remain negative. And this brings up a good point. Investors can still make money in bear markets by being pickier about which stocks they choose to invest in. Bear markets refer to the overall trend of a market being negative, but there will still be blips of positivity in there alongside certain strong performing stocks. Bear markets are going to have 4 set phases, and you should be familiar with them. Number 1 is the optimism that transforms into pessimism phase. This is where investors start to feel more and more negative about the future of markets. Number 2, there's usually a sudden stock drop. As pessimism and fear take over, investors will generally function in a herd mentality, triggering a quick and large sell-off to gap downwards. 3, the period of speculation. This is when stocks have dropped enough, speculators and traders hoping to cash in swoop in and drive up prices of select stocks, increasing volatility in the markets. 4, the final phase is the slow fade. The final segment is when the rate of sell-off slows, eventually declining to flat, and this is when a bottom is put into the market, and after this point, stocks begin trading upwards as a trend, establishing the beginning of the next bull market. One important thing to note about bear markets is that they're not the same as corrections. Corrections are short-term trends over a few months, often referred to as cooling off from an overheated bull market run. Corrections occur during bull markets. Bear markets, on the other hand, are completely the opposite of a bull market, and they're longer-term events and trends that take time to be established. In the last 100 years, the Dow Jones Industrial Average has experienced 33 bear markets, and we'll look at some of the largest crashes here in a second. Once markets shift to bear markets, conditions can deteriorate further as short selling intensifies. This is where investors bet against certain stocks, thus making money when they trend downwards. This should take care of the basics about markets and market conditions. Now we can move on to the next section to begin to understand the different types of assets that you can purchase. There are many different types of assets or investing products that you can buy, and we'll walk through the main ones in this section. Some assets are riskier, meaning they may make you more money, but they could also lose you a lot of money. And other assets are stable, meaning they basically guarantee you some money, but it won't be a lot. First, let's start with some of the most secure assets, bonds. The name's bond, municipal bond. Let's start this video over. Bonds are some of the most necessary and fundamental vehicles in the financial sector. They allow towns, governments, companies, and other groups to get funding. Bonds are essentially just IOUs to the person giving you money, the lender, that says you're going to pay them back sometime in the future. They're a fancy form of a loan that gets companies and governments funding when they need it. What makes bonds different from loans is that they're a form of a security, in that you can buy a bond and start getting payments from the company that owes you. In essence, bonds are securitized loans. Bonds will typically include an end date in their terms when the entire amount of money is due back to the issuer, as well as terms for the interest payments to be made. These are some core principles about bonds to remember if you're looking for a general overview. They're corporate or government debt issued by an organization that are tradable assets in the form of securities. Bonds are stable and referred to as a fixed income instrument. Their payments to holders don't fluctuate over time like the value of stocks or dividend payouts do. Bond prices inversely correlate with interest rates. Since a low interest rate usually means the borrower is trustworthy, more people will want to own that bond because there's little risk. Conversely, high interest rates infer a risky borrower, which increases the chance that a bond will become worthless, thus making them cheaper. Bonds have dates at which point all of their value must be paid back. This is called the maturity date, and beyond this point, the bond ceases to exist. Like we mentioned before, bonds are a way for companies or governments to raise money without giving up ownership of their company, which is what selling stock would do. If a government needed money for a project, they could issue bonds, which investors can buy and be guaranteed payments by the government. Government bonds are typically seen as safe because there's little chance the government won't pay back the funds. Companies, on the other hand, go bankrupt far more often, which would mean any bonds they issued would become worthless. If companies like Apple issued a bond, investors would eat it up because it would be seen as a very safe investment. However, if a company like Blockbuster issued a bond to raise funds to open up a new store, it would be a pretty risky bond. You might be asking yourself, though, why wouldn't a company just go to a bank and get a loan? Well, chances are the bank can't loan them the amount of money they need. In this case, companies have to turn to selling bonds to raise more capital. Bonds provide a way for individual investors and funds to become lenders to massive companies. Think of it almost as a way of crowdfunding corporate or government debt. Finding one bank to give you $20 million might be hard, but finding 20,000 people to give you $1,000 would be a lot easier. Now that we've covered why bonds exist and who issues them, let's talk about the specifics of how they work. Bonds are a form of security, just like stocks, except bonds are generally more secure and offer payments over time and have an end date, which is how investors make their money, rather than buying the stock at one price and selling it higher later. Bonds can be traded publicly or privately depending upon the way that they're set up. While you might buy a bond in a similar way as a stock, the difference is that bonds will come with terms and a plan for how you're going to get your money back. Bonds will include the terms of the loan, the interest payments to be made over time, and the maturity date, the time at which the entirety of the funds need to be paid back to investors. Bondholders make their money through interest payments the company makes to them, on top of paying back the original loan. Interest payments are called the coupon, and the interest rate is called the coupon rate. Most bonds are usually priced at either $100 or $1,000, called the par value. However, prices can fluctuate as people buy and sell them. If a company issues a bond when their financials look good, but then something like, say, a pandemic happens and the company loses all their revenue sources, the bond would fall in value as people wouldn't want to own it. However, since the bond was already sold to investors, in this case it would be the investors who lose their money, not the company who issued the bond. This is the same way stocks and other securities work. It's the risk of investing. The value of a bond depends on these main factors: credit quality of the issuer, date until maturity, and the coupon rate compared to the average interest rate of other bonds. You could buy a bond and never plan to hold it until maturity. Rather, you could buy a bond to just flip it a few weeks later if the price went up. Conversely, you could also just buy bonds and let them sit, collecting interest over time and making your money back slowly. Let's go through some more specific principles of bonds. Face value is the amount of money the bond is worth at maturity. A face value of $1,000 would mean that at the maturity date, the issuing company would have to pay you back the full $1,000. The coupon rate is the interest rate which the issuer will pay. A 5% rate on a $1,000 face value would mean that you'd get $50 per year in addition to the $1,000 at maturity. Coupon dates are the dates when interest payments will be made. The maturity date is the end date of the bond. And finally, the issue price is the initial price the issuer set to buy the bond from them. The major determinants of quality of a bond are the credit quality of the company or government, like a corporate credit score, and the time to maturity. If the issuer has bad credit, the risk of losing all of the bond's value is greater, making the interest rate be higher in order for investors to be willing to take the risk. If the maturity date is further out, the interest rate will usually be higher too, since it will take a longer time to get back the initial investment. Companies get credit ratings from credit ratings agencies like Moody's and Standard & Poor's. Side note, these companies were also one of the main reasons for the 2008 financial collapse, something we talked about in our video on mortgage-backed securities, linked right here. Bonds that are stable are called investment-grade bonds. These are typically US government bonds and strong, profitable companies. Bonds that are risky are called high-yield bonds, or junk bonds. These bonds have a greater risk of losing all of their value, which means they'll pay out a higher interest rate, but you could lose everything if the company goes bankrupt. Main categories of bonds are corporate bonds, which are bonds from companies, municipal bonds, which are bonds from states or cities, government bonds, which are bonds issued by a national bank or government, and agency bonds, which are issued by organizations that are affiliated with governments. There are also unique bond structures different from what we initially talked about. Those are zero coupon bonds, which are bonds that don't pay interest but are rather sold at a discount and paid out in full at the end of the term. For example, you could buy a $1,000 face value bond for $900 and in 5 years get back the full $1,000. Convertible bonds are another type, which can be converted into stock down the line depending upon the stock price. This allows companies to pay less interest to the bond holders that are willing to get stock of the company down the line instead of a higher interest rate over time. For example, a normal bond might have a 12% interest rate, and a convertible bond might have an 8% interest rate, with the ability to be converted into stock if the stock hits a certain price down the line. It's less payments for the company up front, and could be an attractive risk to the bond buyer. There's also callable bonds, which are bonds that a company can buy back if they determine they can get a better interest rate down the line. Say their credit rating improves and interest rates decline. The company could buy back the bond and reissue the bond at a lower rate. Finally, there's puttable bonds. These bonds allow the holders to sell the bond back to the company before maturity, which is a way for investors to protect themselves if they're worried about the company not paying up down the line. Lastly, let's talk about how bonds are priced. Bonds prices fluctuate just like any other security on the market. Just like if a company starts doing really well, their stock price might go up, so might their bond price. If a company starts losing a ton of money, their stock price might go down, so too might their bond price. All of it is a matter of supply and demand, what investors are willing to pay and what somebody's willing to sell it for. In reality, though, there's a variety of technical factors that go into pricing bonds that we won't really delve into in this video. At the end of the day, bonds are just loans to borrowers that individual investors hold, not big banks necessarily. Now that we understand some of the most secure assets on the market, let's take a look at some of the most common, but also more risky, stocks. Buying a company's stock is one of the oldest and simplest investments in the business world. In short, you're making an investment in a company. If that company performs well and grows, the demand for their stock will go up, so too will the stock price, and you can make money by selling the stock or collecting benefits like dividends. Anyone can buy stock, which makes it accessible for even the most unskilled of investors. In order to understand what stocks are and how you can make money with them, let's break it all down. Stocks are effectively shares of ownership of a company. If you own enough stock, say 5 to 10% of total shares, you'd have significant influence on how that company is run. However, most people just own 1 to 10 shares of a company, or more or less, and you still have an influence, but your votes on important decisions will be less of the total votes, so it doesn't matter as much. Most stocks sold on the open market for individual companies give you the right to vote in shareholder meetings. This means that you can vote on who is on a company's board, whether they acquire a certain company, and so on. All of that's cool and all, but it's not really why stocks are usually bought and sold. Simply to make money. Investors buy and own stock in order to make a return on their investment. You can buy a stock whenever and sell a stock whenever, as long as there is a buyer and a seller willing to take you up on the other side of the deal. Most of the time, you aren't buying from the company directly either. Rather, you're buying from another stockholder who wants to sell their position. Companies initially sell their stock in something called an initial public offering, or through other public offerings after the fact. These let the company raise money without having to take out a loan. But all of that said, there are 2 primary ways. For one, the stock appreciates, or in other words, people are willing to buy that stock for more money than you bought it for. If the company makes great decisions and turns a profit, more and more people would want to own their stock to make money with them. This increase in demand drives the price up. Assuming the total number of stocks on the market stays the same, this is simple supply and demand. If you're selling a painting and you only have one person bidding, it'll probably go for cheap. However, if 10 people are bidding on it, it will likely go for a lot more. Stocks can appreciate for any reason, and their value is tied to a number of factors that don't always tie back to just how much money that company makes. Since stocks are sold on an open market through an exchange, their price is more of a reflection of buyer sentiment or how good or bad people think the company will do. Stocks for companies that lose millions of dollars each year can go up in price if the market thinks that they will be more and more successful very soon. The second way that you can make money by owning stocks is through something called dividends. Some stocks, but not all or even most, pay dividends. Dividends are payments directly from the company made to shareholders that come from the company's profits. Think of this as a way to entice people to buy a company's stock and hold on to it. Dividends are paid quarterly and the amounts vary by company, but it's a set amount for each company for each share that you own. Companies would want to pay you a dividend so you hold their stock and don't sell it. Supply and demand means that this will drive the price up over time. Companies want their stocks to go up so that the shares that they still own are more valuable, as well as so that any shares they decide to sell or offer in the future can be sold for more money, generating more investment money for them. We've covered what stocks are and how you make money with them, but what other technicalities are we missing? Companies sell shares or stocks in their business to raise money without taking out a loan that they have to pay back. After a company sells a share, it goes onto the open market. So after the initial offering from a company, you buy shares from other investors, not the company itself. All of these transactions are handled through stock exchanges on the open stock market. We have another video about that linked right here if you want to learn more about how the stock market works in detail. You, the investor, buy a stock through a stockbroker or brokerage. You can use online platforms like Webull, and if you're just getting started, you can even do paper trades, so you can trade real stocks without investing any money and see if you would have made an investment. You also get 2 free stocks at our affiliate link below after you make your first deposit. Some platforms do charge you a fee though when you buy or sell stocks, and others are free. There are different types of stocks that give you different rights or perks for a company. Most investors buying and selling on the open market will own what is called common stock. Common stock gives you voting rights and can pay you dividends. That's about it though. There are other types of stocks, like preferred stocks. The main difference is that preferred stocks have less volatility, so they're a more secure investment in most cases, and they usually get higher dividends. However, preferred stock owners don't usually get voting rights in the company. There are other types of stocks, but they're a little beyond the scope of what any beginner or even experienced run-of-the-mill retail investor would need to know. Long story short, owning stocks just means you hope the company will do well so you can sell your stock for more than you bought it for and turn a profit. Stocks fluctuate all of the time, so when buying or selling any given stock, you'll want to weigh your investment strategy. Are you hoping to sell this in a month, or are you going to hold the stock for years? Each strategy presents different levels of risk and returns. Hopefully, you understand a little bit more about what stocks are and why they exist. Lastly, there are other forms of stock that you can buy on the market that don't represent just one company, but rather represent a bunch of companies. These are called exchange-traded funds, or ETFs. They're essentially a bunch of companies' stocks lumped into one stock, and you could buy something, for example, a technology ETF, meaning that you invested in a bunch of technology companies without having to own each one of the stocks individually. This spreads out your risk and provides you more stable growth, but it also gives you good exposure to the market as a whole. And of course, the potential for explosive growth and returns is usually muted in ETFs as well. And that just about does it. Hopefully you understand a little bit more about what stocks are and why they exist. While stocks in general can be a great investment and are the bedrock to 401ks and retirement accounts, there are riskier subsets of stocks. Some that you might have heard about are meme stocks. With the growing interest in the stock market by new investors, the frenzy has created a new type of stock, the meme stock. Meme stocks don't mean the internet's favorite meme from the week is now trading on the stock market. Rather, stocks for companies themselves have gone viral online, causing investors to purchase them just for the meme. Meme stocks are getting more and more popular, and if you're an early adopter, you can stand to make some crazy returns, like with GameStop or AMC. But let's take a closer look to figure out what exactly a meme stock is. Meme stocks are a fairly new term, and they spawned out of trading hype and hysteria from 2020 and 2021, with discussions of the stock originating on Reddit or other online forums. Meme stocks garnered, and do garner, so much attention simply because of how fast they rise for seemingly no reason. Typically, a good stock would rise 30 to 50% in a year, but a meme stock could make that move overnight. That kind of money gets people talking. Meme stocks can be any stock, whether the underlying company is good or bad. If the internet starts to like it, thousands of retail or non-professional traders pile in, driving up the price. Some recent examples of meme stocks are GameStop, AMC, and BlackBerry. The companies in question don't have great fundamentals, or to say that the companies really aren't that great at making a ton of money. But the Reddit channel Wall Street Bets started talking about these stocks, specifically how much larger, rich investors were shorting the stocks. In simpler terms, this means that big investors were betting the stock price would go down. The Reddit boards and retail investors wanted to stick it to the man and make these big, rich funds lose money. So they all bought the stock, causing prices to soar, and those bets that the stock would go down to lose a ton of money. It used to be that you could make the most money picking good companies, but now you can make millions just by picking the right, bad company, or meme stock. Because meme stocks are driven by online virality, they undergo some common cycles. There's an early adopter phase where investors think the stock is undervalued or overshorted and start buying the stock. Then there's a middle phase where people who pay attention to finance media start realizing there may be something happening and start buying in. These two phases in the beginning are where investors can make the most or any money. Following these first phases, there's the FOMO phase, where people like your grandmother and weird uncle hear that GameStop is going to the moon and start buying in. Generally, by this time, it's too late to make a ton of money, but the meme hype train keeps rolling. After the stock has gone up to crazy levels, those early investors start taking profit or selling the stock, and the stock price starts going down on less purchasing demand. The whole cycle can happen in just a few days or weeks. Meme stocks go to the moon and back at breakneck speeds. For example, GameStop, often regarded as the first official meme stock, first began to surge in January of 2021. The stock went from $17.25 to $147 per stock in a matter of weeks. By January 27th, the stock had rose to $347 per share, and by January 28th, the stock had hit its high of $483 before closing the day at $193. That volatile price action wasn't because the company was good. Rather, the change in price was driven by thousands of people wanting to get in on the frenzy. All of this volatility and craziness has driven an increased interest in retail trading, or just ordinary people not working for a bank trading stocks. Investing in meme stocks can be a fun whirlwind and roller coaster of to the moon, I'm going to be rich, quickly turning to how will I pay next month's rent if you don't sell at the right time. One thing is for sure though, trading meme stocks, if timed and done right, can transform a little bit of cash into thousands or millions in just a few days. Just be prepared to lose all of your investment if you play the game. We interrupt this broadcast to bring you a brief commercial. Stonks, stonks, stonks. So you want to invest your money? Then you might want to think about investing in stonks. Stonks are one of the hottest investments in the world right now. You've probably heard everyone talking about stonks, so how do you get in on the fun? Well, you just take your money, spend it at a stonk exchange through a stonk broker. Easy, you'll be a millionaire in no time. Stonks, stonks, stonks. Buy them now. Now back to your regularly scheduled programming. The last type of stock that is decently risky is something called a penny stock. If you're looking to make some big returns on the stock market, penny stocks might be the way to go. But they're some of the riskiest investments you can make, and you have just as much chance at losing all of your investment by purchasing them. Penny stocks are typically stocks of small companies that trade for less than $5 per share, often even under $1 per share. Penny stocks sometimes trade on larger exchanges like the New York Stock Exchange, though most trade over the counter through private trading groups. One might look at penny stocks and think, well, if this 50-cent stock goes to $1, I'll quickly double my investment. While this is true, just because a penny stock is cheap does not mean that it is a good investment. Generally speaking, penny stocks trade very infrequently, meaning that when you do want to sell, it can be hard to find a buyer. This low liquidity means that without sudden massive interest in the stock, it's hard to actually take your profit when you do want to sell. While some companies start out as penny stocks due to small volume and overall lack of market interest, other companies can become penny stocks if their value drops low enough. If a company announces they're doing quite bad financially over time, their stock could drop from $50 per share down to $1 or $2 per share, which will often cause them to get kicked off their exchanges or delisted, making it even harder to sell your shares of their stock. The reason penny stocks are attractive as investments is because of the significant potential upside. You might buy $100 worth of a 50-cent penny stock, giving you about 200 shares to own. If that company does really well and more people want their stock, let's say the stock price gets pumped up to $10 per share. That means you could sell your investment for $2,000. You just made $1,900 off of a $100 initial investment. That's huge return, and it can happen, but more often than not, penny stocks will leave you with less to little of anything. At the end of the day, there's a reason penny stocks aren't worth much, because they're risky, volatile, and often not the best companies. But if you do like risk, penny stocks might be your thing. But they're closer to lottery tickets than they are like buying a share of Google or Facebook. One of the final main reasons that penny stocks can be dangerous investments is the lack of regulation. Companies listed in the pink sheets or over-the-counter stocks, where most penny stocks are traded, lack regulation by the SEC or Securities and Exchange Commission. That means that they don't have to file paperwork for many actions that may otherwise signal to investors that the company is actually not doing very well. Penny stocks are rife with fraud due to this lack of oversight, making it harder to judge your potential returns as an investor. All of this said, penny stocks can be a fun gamble if you've got a few bucks you're willing to lose on a risky investment. Just make sure you do your research before clicking that buy or even that sell button on your investment. There's also ways to invest in stocks in an incredibly secure and diversified way. ETFs. If you're just getting started in the stock market or have been investing for a while, you might have heard the term ETF. ETFs function like stocks in that they are a security whose value fluctuates, but how they work behind the price is much different than standard stocks. So, put simply, exchange-traded funds, or ETFs, are securities that are made up of a bunch of other securities, usually individual stocks. In short, ETFs track the fluctuation in prices of a bunch of different stocks, usually stocks in certain categories like technology, food and beverage, mining, etc. ETFs trade just like normal stocks on open markets, but provide investors a great level of security and less volatility as compared to singular stock purchases. ETFs are very similar to mutual funds, except that mutual funds aren't listed on exchanges and ETFs are. If you want to put your money away into a safe security and diversify your risk, ETFs are the way to go. Common ETFs are the SPY, or the ETF that tracks the S&P 500 companies all in one security, or DIA, an ETF that tracks the Dow Jones Industrial Average. It's important to note that these ETFs are simply a collection of the companies that these indexes contain, and while they track the price movement of each respective index of companies, the ETFs aren't the indexes themselves, they're the security. In summary, ETFs are a group of stocks or securities lumped together into one security. Their prices fluctuate just like stocks, but their volatility or their change in price over a given time won't be as extreme as individual stocks. There's ETFs for everything, from crude oil to electricity, from food to water. ETFs offer up the exposure of a ton of different companies like Amazon, Tesla, Google, etc., without having to shell out the hefty price of owning each of those stocks individually. If you want to take a more conservative, long-term investment strategy, ETFs are likely the best way to go. Owning significant portions of individual company stock can provide greater return, but it goes the other way too. You could end up losing all of your investment in a company, but not so much in an ETF. The risk is muted. Now that we've gone through the basics of what ETFs are, let's take a look at the different types of exchange-traded funds. Like we mentioned before, ETFs come in all sorts of shapes and sizes, and you can likely find one that covers exactly what you want to invest in. There are bond ETFs, which are made up of government and corporate bonds, industry ETFs, which track industries like technology, banking, or oil and gas, commodity ETFs, which track the prices of crude oil, gold, silver, and other valuable resources, currency ETFs, which track the changes in value of various currencies, like the euro or US dollar, and inverse ETFs, which gain in value when a group of stocks go down. These ETFs essentially short the underlying stock, or bet against them, and go up in value inversely to the stocks. When looking for ETFs on the open market, you should note that many of them are not actually ETFs, but rather exchange-traded notes, or ETNs. While ETFs actually own the underlying stock or security, ETNs are just securities issued by banks guaranteed to track the underlying index without actually owning the underlying securities as part of the ETN. In all actuality, ETNs and ETFs function the same for investors, but when you buy an ETN, just be aware that you're buying a guarantee from a bank, not the actual securities that it tracks. ETFs provide investors lower costs to purchase a wide variety of companies. You could buy a technology ETF, hypothetically, for $50, but if you wanted to purchase all of the underlying stocks individually, you might need something like $10,000. At the end of the day, you get the same return rate, but with much less upfront investment to get the exposure to those companies. Most ETFs have very low expense ratios. ETFs at the end of the day are funds and portfolios and require some sort of attention from bankers, unlike individual stocks. This means that some ETFs can have fees for ownership, but in general, they're very low. ETFs that track indexes will have very low expenses because they don't have to be actively managed. However, if an ETF tracks something like crude oil, it could have high fees as intensive management is needed for the underlying security, in that case, crude oil. The pros of ETFs are that they give you access to entire industries cheaply, give you access to companies and large collections of stock with lower upfront costs, and provide greater risk management to your portfolio as diversification is built in. The cons of ETFs are that they can have high fees compared to stock ownership, can still limit your exposure to the market if you overinvest in one industry, and they don't have as much liquidity, i.e. there's not as many people looking to buy them. ETFs are a great first foray into investing for any beginner and can be a great long-term way to build wealth. Finally, let's talk about one of the most popular and riskiest forms of investing today, cryptocurrencies.
Let's explain crypto in under 3 minutes. Cryptocurrency is a digital form of money or currency that can be sent, exchanged, and transferred without going through a bank or central system through a network known as a blockchain. This means that crypto is decentralized, meaning that it doesn't have a central controlling entity that governs it. But what are blockchains? Essentially, they're a list or a database. Transactions of cryptocurrencies are stored on this list. These transactions are stored in chronological groups known as blocks, hence the name blockchain. Blockchains are also decentralized, meaning that they are managed by a plethora of computers across the world, and the code is all open source, meaning publicly accessible. But how does this make it secure? Well, since so many computers have access to the same information, it can be quickly and easily verified that the information is accurate by checking with the other copies in simple terms. Blockchains can also only be added to, so there's no going back and deleting transactions from the past, giving everyone a secure ledger of all transactions of a given cryptocurrency or set of cryptocurrency. But why is it called cryptocurrency? Well, the blocks stored on the blockchain are all secured by cryptography, hence the crypto in the name. This is essentially complicated computer speak for math puzzles. Transactions are signed and verified by miners, solving complex math problems to verify the blockchain, the ledger of transactions. But what are miners? Miners are essentially just computers solving problems. Computers contribute to the blockchain by doing this work and in return get a reward. Miners typically focus on a specific cryptocurrency, say Bitcoin, doing work for the Bitcoin blockchain. These computers, and by proxy the people that run them, get paid in Bitcoin rewards when they solve problems. It's this system that keeps cryptocurrency working. Cryptocurrencies get their price from their utility, scarcity, or interest. In the case of Bitcoin, the largest and oldest crypto, the max number of Bitcoins that can ever be made is 21 million. Not only this, but as new Bitcoins get mined, the blocks on the blockchains, mined by miners, and rewarded in new Bitcoin, the amount of Bitcoin rewarded for each block decreases over time. So, unlike the US dollar, which has an infinite supply, theoretically, as more and more people transact in Bitcoin, the value goes up and up because there's a finite, limited supply. On the other hand, cryptos can get value from their utility or market interest. Dogecoin is a great example of this. We saw massive gains in Dogecoin, originally created as a meme, purely because there was a lot of market interest. When the interest outpaces the growth of supply, we see the price go up. Supply and demand. Crypto is just digital money where transactions are stored on digital lists, protected by cryptography, and stored on a network of computers, the blockchain.
For beginners, those are probably all of the assets you might consider investing in. The only other major concept that we didn't discuss here is something called stock options. We have other videos discussing these in our channel, but options generally should be only considered by very experienced investors, as they can lose beginners all of their money in just a few minutes. On the topic of losing all of your money rapidly, let's talk about what happens when the stock market goes south and everything turns red. The worst case scenarios. The stock market has done some pretty crazy things in the past, and to understand how bad it can get out there, let's look at one of the largest and most recent crashes, the 2008 financial crisis.
This is how the 2008 financial crisis happened. Investment banks were selling something known as mortgage-backed securities. These are basically a bunch of mortgages lumped together. However, investment banks were running out of good mortgages to put into these securities, so they decided to just loosen up their guidelines for what they qualify as a good mortgage, so they could keep selling more and more and making more profit off these mortgage-backed securities. But these loans that they were selling as good were terrible. Why would someone want to invest in a Walmart cashier's $1 million home loan? Surely they're not going to pay that. The big banks knew that, but they also knew that there was probably safety in numbers. The original mortgage-backed securities, the ones based on conforming loans or good loans that were actually good, are safe because if 20% of people default on their loans, investors in those securities still get a good return. Not everyone will default. The investment banks that were selling these securities
thought, or at least publicly said, that if they group a bunch of these terrible new loans together, that there's still safety in the numbers. While one loan on its own might be at crazy high risk of default, if you put 1,000 terrible loans together, there's no way they're all going to default, right? Ultimately, while each of the loans might have been a pretty terrible investment on their own, the argument they were making was that if you put them all together, not everyone will default, and you can in turn get some pretty high interest rates at the forefront, and these banks were selling these securities like crazy. Since the loans were risky, the banks could charge insanely high interest rates in the securities and make them incredibly attractive to investors. Lump all of these loans together into mortgage-backed securities with high returns, and investors at the time were eating them up. But you're probably thinking, if that was true, then why would investors in mortgage-backed securities want to buy them if they knew the loans that they were made up of were terrible? Couldn't they tell the investment banks were lying? Well, they could, if they looked, but no one was looking, because the agencies responsible for independently rating these securities on how good or bad they were rating them all as AAA, meaning the highest value and safest investment. Investors took the rating agency's word, which were supposed to be independent companies, and they bought up all of these mortgage-backed securities that were rated by them. The problem was, the investment banks were in the pockets of the rating agencies. They needed the agencies to rate their mortgage-backed securities well so that they could sell their securities and their loans to investors. And the agencies needed the banks to pay them so that they could make money. The banks refused to pay them if they didn't rate their securities AAA, knowing full well that the loans that they were actually rating were all terrible. Long story short, investors like banks and hedge funds bought these MBSs thinking that they were a safe bet. Insane numbers of borrowers actually defaulted, as you'd expect a Walmart cashier to do on a $1 million loan, and investments became worthless, and the investors all lost their money. This collapse of the mortgage-backed security market had ripple effects through the entire US economy, with banks going bankrupt, the stock market collapsing, and the US getting thrown into a recession. All because a bunch of bankers got too greedy with the investment products they created and started selling lies. So that's, in short, how the crash of 2008 happened. Now that we hopefully understand the 2008 crash a little better, let's look at the rest of the largest crashes in stock market history. Is the stock market going to crash? I have no idea, but it has definitely happened before. Let's take a look at the biggest crashes in US stock market history, and make sure you watch until the end to learn about the time the stock market crashed nearly 90%. Let's start with Black Monday in 1987. On October 19th, the Dow Jones Industrial Average plunged 22% in a single day. This is the biggest single-day decline in history. By the start of November, nearly every index in the market was down more than 20%. No one was safe. But what caused this? Well, nothing in particular. Rather, it was a series of events like a growing US trade deficit, the growth of algorithm-based computer trading, and growing tensions in the Middle East. The significant rapid drop on Black Monday was likely due to computer algorithms deciding to pile on to the sell-off, crashing the market even further though. Next, let's talk about the dot-com bubble of 1999 and 2000. The Nasdaq Composite, the index that tracks tech companies, had surged nearly 400% since 1995. It peaked at 5,048 points on March 10, 2001. By October, the index was down nearly 77%. This crash wasn't as quick as Black Monday, but it was just as significant. The popping of the dot-com bubble refers to the overvaluing of internet and technology stocks that occurred in the years prior, as investors came to terms with the realities that these companies might not be all they're cracked up to be. Their values plummeted. It took the Nasdaq 15 years to reach the peak it had hit in March 2001 again. The financial crisis of 2008 was also pretty sizable. This crash was due to increasingly liberal lending guidelines, increasing the number of subprime loans that made up the mortgage market, held in securities known as mortgage-backed securities. If that sounded like word soup, I have a video explaining the 2008 financial crisis for dummies linked right here. Essentially, home debt ballooned, people couldn't pay their mortgage, and the entire mortgage market collapsed. In March 2007, Bear Stearns, an investment bank, went bankrupt. This was a warning sign, but the market kept growing, hitting a peak in October of 2007. By September 2008, though, the market was down more than 20%. By March 6, 2009, the market was down a total of 54%. The 2008 crisis was essentially the slow collapse of the entire US financial system. It took 4 years for the Dow to rebuild from the crash. This next crash is one that you might remember, the coronavirus crash of 2020. During February 2020, the market crumbled 12%. On March 12th, the Dow tumbled 9.99%, the single biggest drop since Black Monday in 1987. On March 16th, it tumbled another 12.9%, beating the record set just 4 days earlier. But what makes the coronavirus crash unique is that the market recovered nearly instantaneously. It was already back up to its previous peak by May of 2020. But why did this happen? Well, basically because the Federal Reserve essentially decided to print money endlessly, propping up the US economy alongside Congress's stimulus packages. If you want to learn about the Federal Reserve and what they do, you can watch my video on the topic here. Finally, let's talk about the stock market crash of 1929. It's the worst crash in stock market history, and it kickstarted the Great Depression. In 1921, the Dow rose from 63 points to 381 points by 1929, basically 600% in less than a decade. On September 3rd, 1929, it started dropping. On October 28th and 29th, the market crumbled 12% and 13% each day, respectively. By November, the Dow was down more than 50%. This continued until the summer of 1932, when the market was down to just 41 points, 89% off its high set in 1929. It would take until 1954 for the market to regain its value. The crash of 1929 was due to excessive leverage. Many investors and businesses were using debt to buy stocks, meaning that the market was propped up by cheap debt. But when the market started going down, no one could pay off that debt, and thus the market crashed. And that's the history of the largest crashes in US stock market history. Finally, it's important to discuss national debt and the agency that controls it, the Federal Reserve, as we're trying to understand market crashes. Let's start with an overview of the Federal Reserve.
What the Federal Reserve? What is the Federal Reserve? Often called the Fed, the Federal Reserve is the central bank of the United States and is by and large the most powerful financial institution in the world. The Federal Reserve System holds the monetary authority of the United States, and its goal is to provide the country with a safe, flexible, and stable financial system. It's currently run by Jerome Powell, who serves as the chair. Throughout history, there have been about 16 chairs, who essentially run the bank like the CEO of a company would. But why the Federal Reserve? Established in 1913, the Federal Reserve Act was signed into law by President Woodrow Wilson. Pre-Federal Reserve, the U.S. was the only major world power without a central bank, the lack thereof being attributed as a core cause of the 1907 financial panic, and thus the Wilson administration's motivation in establishing it. The Federal Reserve, being the central bank, has broad power to act and ensure the financial stability of the U.S. and is the key regulator of banks that are part of the Federal Reserve System. Essentially, the Fed functions as a lender of last resort, ensuring that these banks never run out of money. The Fed carries out 4 main duties: influencing and conducting national monetary and credit policy, supervising banking institutions to ensure legal and secure actions, ensuring the U.S. economy is stable and not at systemic risk of collapse, and finally providing financial services through payment and money printing.
Being the central bank, the Fed simply oversees and regulates the money supply of the entire US economy and sets interest rates or lending rates between banks. The Fed can ease or tighten money supply and available credit as dials to keep the economy functioning properly. But how the Federal Reserve does its job of ensuring a stable and secure economy is another question entirely. The Federal Reserve has many dials to turn to enact monetary policy. It can choose to print money, for one. The Federal Reserve issues all paper money in the US, known as Federal Reserve notes, and by printing more or less of it, it essentially controls the money supply in the country. The Fed can also set interest rates. These are the rates of what interest is charged on lending, and these can primarily control what happens to inflation. The Fed targets an inflation rate of about 1 to 2% each year, which is considered healthy by economists. Since the Fed is a private bank, it does have to make money of sorts. It does this by charging interest on government securities it has acquired, along with returns on foreign currency investments, loans to banks, and fees for services such as clearing and fund transfers. If the Fed turns a profit, it turns over any profit made each year after expenses to the US Treasury.
Now that we understand the Fed, let's understand the current situation surrounding US national debt. The United States is in a lot of debt. Currently, the country owes $27.2 trillion. But who would even lend them that much money? Who does the US owe this massive sum? Well, the answer to that is pretty simple. In large part, it owes itself that money. But there's also quite a few other countries it owes too. The US essentially owes two groups of people: the general public, which can be other countries or even investors in the US, and itself. But before we get into who makes up those groups and what the percentages look like, first, let's get some basics. Whenever the US government needs money, it raises that money through the issuing of savings bonds or treasury bonds. These bonds are basically pieces of paper that say the US will pay the person or agency that buys it back with a little bit of interest. Many people want to buy bonds because they're pretty solid investments, like banks, foreign governments, and maybe even you. The debt ceiling, which you may have heard about, is actually the cap that is set on what the US Treasury can issue in terms of bonds. Congress will raise the debt ceiling to finance government spending through the sale of more of these treasuries. With those basics out of the way of how the government is funded, who actually owns all of these bonds? No, it's not really one of our enemies or some secret super powerful group. Foreign governments and investors only own about 30% of overall US debt, whereas the remaining 70% is either held by US investors, the Federal Reserve, or even the US government itself. US investors, like banks, institutions, and regular people, own about 33% of the total debt. The Federal Reserve, or the US's privatized central bank, owns about 12% of the total debt. The US government itself actually owns roughly 27% of total debt. That may not make a lot of sense, but this is essentially agencies like Social Security, Medicare, and disability insurance buying up debt from the US Treasury and using interest payments on that debt to fund their own programs. Normally, you couldn't loan yourself some money, but in the case of governments that print the currency, they actually can. The remaining roughly 28 to 30% of debt is owned by foreign investors, the largest being China and Japan, but Brazil, Ireland, and the UK are other big purchasers. Investing in US treasuries allow these countries to control their currency value in relation to the US dollar, which can be beneficial for trade and other monetary policy. So, at this point in the video, you're likely wondering why you'd even want to invest in the first place, and you might be thinking you just want to run away and hide. And I don't blame you. Investing can get scary. It's important we realize this so we can make smart and sound investing decisions with our money in the future. So, should you invest? Should you start investing? The answer to that question is complex and unique for every situation, but if you're looking to grow wealth, then the answer is likely some form of yes.
Being a successful investor requires patience. For many that start investing, they jump into stocks like GameStop, AMC, or crypto and expect to be instant millionaires. While that has happened before, that style of investing is dangerous and will likely cause you to lose some money in the long run. Everyone can get lucky once. But should you invest? First, you need to figure out if you even have enough money to invest at all. Before you start dumping money into the stock market, crypto, or other accounts, you'll want to evaluate whether you can pay your monthly bills, have an emergency fund of sorts, or have any high-interest debt. If you can pay your bills, have a little money saved up for emergencies, and don't have any high-interest debt like credit cards, then you should probably start investing any leftover money that you have. This way, you can protect your money from inflation. If you're curious about how that works, watch our other video here. However, if you can't pay your bills, don't have an emergency fund, or have high-interest debt, you need to focus on figuring those things out first. Building an emergency fund and paying your bills are safeguards to keeping financial stressors out of your life. Paying off high-interest debt is important because it's costing you more money than you would make investing. If you have credit card debt, you're probably paying somewhere in the range of 25% a year on that money. That's a lot as far as investments go. Investors generally expect anywhere from 5 to 15% return on their portfolios each year, and that means if you invest the money you could have used to pay off that debt, you're actually losing money, even if your investments make money on paper. With that said, notice that I'm saying high interest debt. Generally, you can make more money investing than you'd lose through low interest debt with a rate less than about 5%. Of course, this isn't investment advice, and if being debt-free helps reduce your stress and helps you spend less, then take that route as well. Each situation is different. Just note that it isn't always advantageous to pay off low-interest debt like Dave Ramsey or others recommend. It can be, but each situation is unique. So if you've got all of that taken care of, the answer to should I start investing is probably yes. If you don't really know how to invest or even what the stock market is, take a look at our video on that topic for help here. The best path to start is generally going to be investing in indexes or long-term growth opportunities. You might also consider investing in ETFs, which are explained in our other video here. Don't expect to make millions overnight, invest a little consistently, don't touch it for a long time, and your money will likely grow and grow. Also, don't forget about compounding interest, one of investing's biggest advantages to just keeping your money invested. For most people, while they may have some fun money that they manage themselves on the side, one of the best ways to secure exposure in the stock market and save for retirement is through something called 401ks. Let's take a look at what 401ks are and how they work.
The term 401k has become fairly commonplace in the world of investing and employee benefits ever since the accounts were created and introduced in 1978. Most full-time employers nowadays offer a 401k account as part of their overall benefits package, with many offering employer contributions to help you save more. Let's take a look at some background to the 401k, understand how these accounts work, and help determine whether you should be taking advantage of your 401k options. 401ks started in 1978 after a portion of the Internal Revenue Code was updated with Section 401k stating the creation of a specific type of investment savings account that allowed taxpayers a break on deferred income as well as employers to help with contributions. This marked a shift in employee retirement structures, away from pensions and to employee-funded accounts. This gave workers more freedom in where they worked and for how long they worked there. However, it put almost all of the responsibility of retirement savings on the worker, not the company. Contributing money to 401k plans allows you to tax defer the amount that you've contributed. This means that the contributions you make in any given fiscal year are subtracted from your gross income before your income tax is calculated. You do still pay tax on the money, however, just when you take the money out at the age of retirement. In general, 401k plans allow for you to start taking out the money at age 59 and a half, depending upon your plan plan rules. All of this may sound simple, but let's take a look at an example of how this can be applied to maximize your retirement benefits and minimize your tax burden now. If you make $100,000 per year and you contribute 15% of your pay, the expert recommended percentage, to 401k plans, that comes out to $15,000 per year. Getting paid twice per month, you'll have 24 paychecks throughout the year, meaning that each paycheck will have $625 deducted pre-tax and placed into a 401k savings account. When you file income taxes at the end of the year, your income will no longer be $100,000. Rather, it will be $85,000 to start, as you won't be taxed on your 401k contributions. Getting taxed on $85,000, assuming absolutely no other deductions, which you will have, but for the sake of this, we'll ignore, would mean that you pay roughly $14,000 in taxes for that year, compared to if you were taxed on the full $100,000, you would pay $17,500 in taxes. At the end of the day, the 401k account allowed you to save $15,000 in income while also saving $3,500 in taxes, compared to if you had just put that $15,000 in a savings account, because you would get taxed on that savings. Ultimately, this helps you maximize your retirement savings while also helping you save money on taxes now. Not to mention, most employers have 401k matching contributions. So, if your employer matched 75% of your contributions up to $5,000, a somewhat typical matching range, you'd get an extra $5,000 in savings from your employer, tax-free, on top of your regular income that you wouldn't have had before. This means that participating in the 401k plan in this instance saved, or made you, depending upon how you look at it, roughly $8,500. In general, you should always make sure that you contribute enough to your 401k account to get your full matching contribution from your employer. It's essentially free money on top of your base salary, always up for grabs. You may not get it now, but you'll definitely thank yourself when you're in retirement later. One of the biggest reasons to participate in 401k plans as soon as possible is due to compounding interest. In general, you can earn roughly 6% per year on your 401k investments in a good economy. This means that if you invest $10,000 one time at age 25, by 65, that will be $120,000. This is simply what happens when money is allowed to earn interest each and every year. But the effect is maximized the more time you leave the money in the account. Contributing $10,000 at age 35 would only transform into $60,000 in retirement. The contribution is only 10 years later than the first example, but it's half of the retirement money. Start saving early and start saving as much as possible. Now, there's another type of 401k plan too, one that doesn't allow you to tax defer and rather makes you pay taxes on your contributions now. There are some advantages to this, and it's called a Roth 401k. Roth contributions function essentially the same way as just putting money into a savings account would when it comes to tax time. In other words, you're still taxed on your contributions in the year you made them. However, you aren't taxed on that money in 40 or so years when you take it out, when it's 10 to 20 times as much. This ultimately means that over the span of your life, if you have a smaller tax burden in sheer numbers, getting taxed on $10,000 of contributions is monetarily less than getting taxed on $100,000 in 40 years when you take that initial $5,000 out. Roughly, it's the difference of $2,400 in taxes versus $24,000 in taxes. That's a lot of money, but Roth means that you take all the tax burden now, which some people may want to avoid. There's another note to mention here. The US government has a cap on 401k contributions that you can make each year. In the current fiscal year, the cap is $19,500. It's changed over the past several years, and it changes in some years based on government regulation. This only applies to your contributions, not employer matching contributions. This cap is also different if you're over 50, as the IRS allows an additional $6,500 in catch-up contributions on top of that $19,500 limit. So, should you contribute to a pre-tax 401k or a Roth 401k? If you earn a lot of money each year, meaning you fall into a high tax bracket, it's likely better to contribute to a pre-tax 401k. However, if you aren't in a high tax bracket, then Roth is likely the way to go. You can also invest in both and shift the way you contribute around at any time. A general rule of thumb is to invest in Roth in your early career and shift to pre-tax as you get older. However, what's best for your specific situation can really only be figured out by calculating the numbers. So, after you've saved all of your money you need for retirement, when do you actually get it? Each plan is different and generally follows a vesting schedule, or a schedule of when you get your money. General rules of thumb are that you can't take out money without fees until 55 or 59, depending upon the plan. However, you can take the money out at any time. You'll just be charged a very hefty fee in doing so before you're retired. The money is technically always yours, it just has some regulations in how you can use it before retirement age. That said, many 401k plans also allow you to take out low-interest loans using your entire 401k account as collateral. This can provide 401k participants some solace if they ever do fall upon hard times. 401k plans are also more than just set it and forget it plans. You not only contribute money, but you get to decide how that money gets invested and allocated. Depending upon your age, you'll want to set risk appropriately. Most 401k plans, if not all, will have specific portfolios you can select depending upon when you're planning on retiring. These will be managed and are in general some of the safest ways to manage risk in your account. However, if you have some investment chops or just want to be riskier with your money, hoping for higher rates of return, you can set your own investment portfolio, leveraging more of your money into more volatile stocks or funds. This provides you more possibility for large growth, but it also means that you could lose money if you're not careful. 401k plans, in the US at least, are some of the most powerful ways you can leverage your income and make your money work for you. If you don't have a 401k plan through your employer, look into other investment accounts like IRAs, internal revenue accounts. These function in similar ways as 401ks, but are a little beyond the scope of this particular video. At the end of the day, make sure you're saving for retirement as early as possible. This will allow you to maximize compounding interest and transform your initial contributions into as much money as possible.
Finally, after you've invested all of your money in the market, you might start wanting to understand how much money you've made and how well you're doing. One of the best ways to do that is through something called net worth. We'll now discuss how to calculate your own net worth. You likely often hear mentions of celebrities being worth $10 million, or like Elon Musk being worth a reported $274 billion. But how is that calculated? And how much are you worth? When people discuss net worth, it essentially means the value of that individual or company, or rather being the summation of all assets and all debts a person or company holds. The formula for net worth is basically adding up all of your assets like house, car, bank account, etc., and subtracting off all liabilities or debts. If someone's net worth is negative, it means that they owe more debts than they have in assets. While this can happen, it's definitely a scenario that you or your company want to avoid. In the case of most companies, net worth is used partially to determine share price or how much debt the company can take on from banks. Lenders, like banks, will calculate net worth to determine how much liability they're taking on by giving a company a loan. Personal net worth, on the other hand, is in most cases a vanity metric used to portray how wealthy someone is, but it can have implications to the loans you're able to get or be used to determine personal financial goals for the future. Examples of personal liabilities or debts include mortgages, credit card debt, student loans, personal loans, and car loans. Personal assets include bank balances, as well as the value of stocks and bonds, property value, market value of cars, and the market value of selling off everything else you own. For example, if you wanted to calculate your net worth, it might look something like this. Your house is worth $250,000. Your investment portfolio is worth $50,000. Your cars are valued at $30,000. Summing all of this up, your total assets are valued at $330,000. Now, sum up your liabilities. You might owe $150,000 on your mortgage and still owe $20,000 on your cars. This means that the sum of your liabilities are $170K. Now it's just simple subtraction. $330K minus $170K is $160K. That means your net worth is $160,000. Now, since net worth is dependent upon the value of things, as the value of cars and houses change, so too does an individual's net worth. Higher net worths can be used as a target for individuals looking to pay off debts, or simply as financial goals to reach at a given age. And that brings us to the end of our Investing 101 course. Hopefully you learned something, and this can serve as a good foundation for you as you seek to invest money, save for retirement, or try to make it on Wall Street. We have tons of other videos about investing on the channel, as well as other educational content outside of finance, and you can take a look at those videos here.